Apple will report fiscal second quarter results after the close on Tuesday. And to prepare, we're going to run through our usual analysis using our Apple Inc. earnings model to take a look at management's guidance and see where it stands relative to the consensus estimates. Now, if you'd like management's guidance, it's in the last press release of the fiscal first quarter results. You can see right here, they give some details for revenue, gross margin, operating expenses, other income, and tax rate. So they don't explicitly say what the EPS is going to be, but if you make some basic assumptions for the share repurchase program and the general change in diluted shares outstanding, you can actually get back to an EPS pretty easily. So that's what we've done in our earnings model. And if you'd like to download our earnings model and follow along or plug in your own assumptions, it's available on our website, gutenbergresearch.com. If you click on the Models tab, scroll down to Apple, and then just click this icon to download. Okay, so with that, we're going to take a look at our model. There were a few important things that we thought about this quarter when we were making our updates to our earnings model. One is the new product introductions that came out this quarter. So we had the iPhone SE, which is the 4-inch display retailing at $399 per phone. And they also had the 9.7-inch iPad Pro. So we don't think that this would actually have any meaningful impact to earnings this quarter, but it could come into play when we talk about the guidance that management's going to give for the June quarter end. And then in addition to that, they're going to probably also have some comments regarding these new products and how they impact the installed base. Remember that last quarter was the first time that management actually gave the details for the installed base. So if you go back to the press release and you click on this supplemental material tab, you'll get this where they go through the constant currency comparison from quarter over quarter and year over year. And then you get this detail of the service revenue, which is generated based on that installed base. And they did announce that they actually reached the $1 billion mark. We haven't incorporated this installed base number into our model yet because it was probably just a point in time saying that they've reached 1 billion. It's unlikely that they're going to actually give us quarterly installed base numbers. If they do, we'll definitely incorporate that in there and use it as a way of improving our expectations for the service revenue. But for the time being, we're going to leave it out. So we'll also be looking at the continuation of the macroeconomic headwinds. So a lot of the emerging markets especially are still struggling to some extent from a macro standpoint. And this would likely impact Apple's results, although they did gain share over their competitors last quarter. So if that trend continues, then the macro environment will be kind of muted again this quarter. Also thinking about the US dollar, it has remained relatively strong against other currencies, although the dollar index has come down over the last 3 months or so. It's still, when you look at the year-over-year comparison, still well above the levels that we were at last year. So I'm sure that that is going to be another main topic on this quarter's earnings call. So let's take a look at our Apple earnings model. If you're new to our modeling approach, it is pretty much consistent with the other companies that we model. So we have the historic details shaded in dark gray headings, and then we have the forecasted future periods in light gray headings. Anywhere you see orange cells, those represent consensus estimates. Purple cells represent company guidance, and our blue cells represent our primary assumptions. So for Apple, we have the income statement up top. Below that, we have the segment details, and you can see that basically the driving forces of the income statement are right here. So we have the average selling price for each one of the products, and then our estimates for the units for each one. So if you take a look at just, say, iPhones, we're modeling 52,000 units of iPhones sold at an average selling price of $682 per unit, which is a little bit below what we saw in the December quarter. So we go through each one of those different products, and then the top revenue line is just referencing the total sales by product down below in the segment details. So you can kind of see how our income statement is constructed. And then you can just work your way down the income statement. So you can see for cost of goods sold, we're just backing into it based on our gross margin percentage down here. Then we have some assumptions for R&D and selling and general administrative expense. So we just take that as a percentage of total revenue, and that's in the ratio section here. That gets us down to the operating income line on the income statement. And then we have, similar to the operating expense items, we have this other income. and that is just referencing our ratio of other income to total sales. And then that gets us down to our income before taxes. We apply an effective tax rate also in the ratio section of our segment details. That gets us to total net income. And then from there, we just calculate a basic growth rate. In this case, it's actually a decline in total number of shares. And then we make some assumptions about the company's repurchase program. So right now, we are estimating $4 billion of capital returned in the form of share repurchases at an average price of 105 shares, which means they would retire about 38 million shares during the quarter. So just above where they were in the fourth quarter, well below where they were in, just below where they were in the fourth quarter of last year, but above where they were in the first quarter of this year. Okay, so now that you see how our income statement is constructed for our future period forecasts, let's take a look at the estimates that we use to get back to the consensus estimates. So you can see that for next quarter, and in fact the next 4 quarters, we've calibrated our model to meet the consensus revenue estimate, which is indicated by these orange cells here. And we've also calibrated to meet the consensus diluted EPS estimates as well. So let's take a look at the sales numbers. So for sales, if we go down to the details by product, we have some growth rates. So here are the iPhone unit growth rates. And let's kind of take a look at that in regards to what happened last year. So in December of 2014, we had the huge ramp due to the iPhone 6. So we don't have a new iPhone model or we didn't have a new iPhone full ramp in December of 2015. That'll actually come later. And we'll start to see that growth in December of 2016. So it's a little bit lower than what we saw in 2014 at 55% growth quarter over quarter from the September quarter in total iPhone units. So that was the December quarter of this year. And then from there, we actually brought our unit assumptions down for this next fiscal quarter ending in March. So we're going from 75,000 units approximately to 52,000. And we also brought our average selling price down to $682 from $691 last quarter. So for the average selling price, that's going to be impacted by the mix of iPhones that are sold. So if they sell more iPhone Plus models and the higher storage capacity models, then that average selling price could increase. But for right now, we're modeling it between the 670 average selling price that we saw in the fourth quarter of last year and the 691 average selling price that we saw in the first quarter of this year. And iPhones tend to be the most important part of Apple's earnings. So if you look at last quarter, iPhones represented $51 billion in total revenue, and none of the other products come close to that. So that's usually where most of the focus is from the analysts. But you can kind of take a look at the other assumptions that we put in here for the second quarter. So we've got the iPhones declining quarter over quarter 30%, iPads down 45%, and if you compare that to the second quarter of last year, it's about in line. So we saw a 41% decline last year. We're estimating a 45%. And then you look at Mac growth. So for the second quarter of 2015, Mac sales were down 17%. We're estimating down 25%. But we kept the average selling price pretty much consistent for Macintosh computers from the first quarter. And also for iPads, we have them flat at 425 basically, so a little bit lower than what we saw last quarter. So when we put all those estimates in, you can see that we get back to about $52 billion in total revenue. And if we take a look at management's guidance, they had set their revenue target range between $50 billion and $53 billion. So we're just above the midpoint of that guidance. Next, we move to gross profit. So for gross profit, we decided to go right in line with the street. So let's see. That was 39.47% gross profit margin, and management guided gross profit between 39% and 39.5%. So that represents the high end of that range. Okay, so let's go back up to our income statement. That brings us down to the two OPEX items, so research and development and selling and general and administrative expense. So management doesn't actually give guidance for each one of those two items independently, but you can see that they give total operating expense guidance between $6 billion and $6.1 billion. So if we go back to our model, you can see that we have modeled exactly $6 billion, so the low end of management's guidance there. And then management guided other income to $325 million. So that's not a huge part of earnings. We decided to just go ahead with the exact guidance that management gave us there at $325 right here. And then they also gave us a tax rate of 25.5%. So no sense in moving away from that tax rate. So we just went 25.5%. And when we do that, we get back to an EPS of $2, which is in line with consensus estimates. So what we would say is, the consensus is just above the midpoint of management's guided range for revenue, above the range or at the high end of the range for gross profit, at the low end of the range for operating expenses, spot on with other income and taxes. So all in all, the consensus estimate is in line with management's guidance, but probably closer to the high end of management's range. We'll take a quick break here, and then when we return, we'll discuss our price earnings and DCF-based valuation. So our Apple model is a Tier 1 model, which means we are forecasting not just the income statement, but also the balance sheet and the cash flow statement. And our valuation is based on a two-pronged approach. So we have our price earnings based multiple valuation, and then we also have our discounted cash flow valuation. So for the multiple valuation, it's relatively straightforward. We take the average multiple on an X cash basis, and we apply that to the next 12-month consensus EPS estimate, and that is how we get back to our price earnings based multiple valuation of $103. So just one other thing to note here is you can see that our adjusted cash is a bit different from our net cash per share. And the reason for that is that we're applying an adjustment related to the overseas cash balance. So if Apple wanted to repatriate those funds back to the United States, they would have to pay a tax penalty. So that's all this calculation is doing. It's taking the overseas cash balance and applying the effective tax rate, which is just a simplistic, overly simplistic approach to trying to calculate what that tax liability might be. And then the DCF approach is a bit more complex. So what we do here is we calculate a weighted average cost of capital, and to do that we calculate the constant Sharpe ratio over time, which we've already estimated at 0.3 times, and we apply Apple's beta to that constant Sharpe to come back to the equity risk premium, which is 6.1%, and then we use the capital asset pricing model and that equity market risk premium to get back to the required return on equity, which we estimate here for Apple at 10.8%. And then we weight the company's debt and equity to come back to the weighted average cost of capital, which is about 10% here. Then we use that weighted average cost of capital to discount the cash flows. So we do a two-stage approach to our DCF. The first stage discounts the next 5 years cash flows, and that's kind of represents our growth stage. And then at that point, we hold growth constant at 2% in perpetuity, and that represents our terminal value. So when we go through that calculation, we end up with a share valuation on a DCF approach of $108. So when we do the 50-50 weighting of the two approaches, we get back to $106, which is about where shares are trading now. So obviously, based on the assumptions here, you would expect the price to come back to be about in line with what shares are doing right now. And we do this as sort of a base case scenario. So you can download this model, plug in your assumptions to the blue cells, and see what the impact is on valuation. And the other reason we use this sort of base case scenario method of valuing shares is that we can leave these assumptions constant after the company reports earnings, and then we can just update what the earnings or what the new guidance is for the company next quarter, and also the March quarter results, and then we can instantly see what the impact is on valuation, keeping these assumptions the same. So it's actually a pretty good way of isolating the impact of changes in value based on earnings only. So when the price starts to move in after hours, after they report, we can get a view on whether or not that after hours move makes sense. So be sure to join us after the company reports results. We'll update this column, and we'll also update this column to include management's new guidance, and we'll take a look at that price move and see if it makes sense. So thanks for watching, and good luck with the rest of earnings season.